Hello and welcome to the Daily Brief. On this show, we cut through the noise and simplify the biggest stories and trends that are shaping the markets. I'm your host Tarun. Today is Monday, August 19th, and I have three big stories for you. You can find us on Spotify, Apple Podcast, or wherever you consume your podcast. And if you like reading instead of watching or listening, you can subscribe to our no spam newsletter for a quick rundown. You can find all the links in the description. So let's start with the stories. I first discuss whether quick commerce is a bubble. I then explain why your electricity bill may go up. And finally, I talk about how China's troubles are getting worse. So let's start by talking about quick commerce. Remember the early days after the pandemic when quick commerce companies like Grofers, which is now Blinkit, and Zepto were starting to become popular. And we were all making jokes that this was another thing VCs were blowing money on. Well, against all odds, quick commerce companies seem to be doing well, and VCs are hot for it. In the last week alone, I saw two headlines. The first one was that Zepto is reportedly close to finalizing an investment of $340 million. That's a lot of millions. The second story was about Ola entering the space. That begs the question, is there anything that Ola is not entering? Look, whether we like it or not, we can't lie to ourselves that we are addicted to the convenience of getting everything from onions to air coolers in 7 minutes. A lot of people have reduced their grocery shop runs and are instead ordering on Blinkit and Zepto. But if you think about it, how can a business which involves delivering Snickers in 7 minutes make sense, let alone be sustainable? So I tried to make sense of the economics of quick commerce. Let me give you a quick overview. Let's start with the total addressable market, or TAM. This is what gets VCs hot for anything. Goldman Sachs estimates that the overall retail TAM is worth $845 billion. Of this, it estimates that quick commerce can become as much as 20% of the total retail pie, which is about $150 billion. That's a lot of billions. But the shocking thing is that quick commerce is a recent phenomenon. Just a decade ago, quick commerce was non-existent. In terms of the players, Zomato's Blinkit, according to a report by JM Financial, has a market share of more than 40% by gross merchandise value. A few years ago, Swiggy's Instamart was one of the dominant players, but it's become relatively less popular. A survey by business news site Ken showed that Instamart was not even the second choice for users. Zepto seems to be gaining market share at the expense of Instamart, despite being younger. Maybe that's why Zepto has been able to raise back-to-back rounds of funding. As of the last round, they were valued at a massive $3.6 billion. Now, we don't have a lot of numbers since Zepto and Instamart are private, but some of Blinkit's numbers are available since Zomato is listed on the stock exchanges. Let me explain how quick commerce works. So at the heart of these quick commerce deliveries lie hundreds of so-called dark stores and thousands of delivery partners. A dark store is a micro warehouse located close to high-demand neighborhoods, like dense residential neighborhoods. These stores are located in places that enable the quickest possible delivery. Blinkit has about 639 dark stores and aims to get 2,000 dark stores by 2026. These stores operate on a franchisee model. It costs about 90 lakhs and you earn commissions of about 3 to 5%. A typical dark store processes about 1,500 to 1,700 daily orders on weekdays and 2,000 to 2,500 orders on weekends. According to JM Financial, the average dark store cost per order works out to be 22 rupees if a dark store is doing 1,400 orders per day. Now, last mile delivery, that is the delivery from the dark store to the customer's door, is the biggest cost for quick commerce platforms. Zepto and Blinkit use a mix of electric and petrol motorbikes and bicycles. Bicycles are used for short deliveries, that is less than 1.5 kilometers, while motorbikes are used for longer distances, that is more than 1.5 kilometers. According to an estimate by JM Financial, delivery partners make a net amount of anywhere between 3,800 to 4,100 rupees per week. The average order value, or AOV, for quick commerce, I'll refer to Blinkit in this case, has gone up significantly. In the recent quarter, the AOV was 625 rupees and the gross order value, or GOV, which is the total amount of money made from all the orders placed before cost, was more than 4,900 crores, up by 130% compared to the last year. But the question still remains the same. Will these platforms be able to grow at this rate, or is it all just hype? And will they become profitable? The management of these companies think they will get there soon. they are trying different things to increase their take rate, like increasing the platform fee gradually. There are also advertising revenues, which are starting to increase at a good pace. But the fact remains, we don't have a profitable quick commerce model globally. Will India be the exception? I guess we'll see. Deepak Shenoy, CEO of Capital Mind, in a conversation with Ken, said an interesting thing, and I quote: "The problem with this narrative of quick commerce is that in the end, when you come to the public markets, you're going to have to drive eventually on the back of these narratives. If the narrative is strong, you're going to get valuations." Now let's move on to why your electricity bill may go up. The Supreme Court delivered a stunning judgment that will make the lives of several metal and mining companies hard. In a recent judgment, it allowed state governments to levy a mining cess on land where minerals are mined. It also said that the state governments can collect taxes going as back as April 1, 2005. The only silver lining is that states cannot charge any delayed interest or penalties on these taxes if they were due before July 25, 2024. The payment of these back taxes will be spread out over 12 years, starting from April 2026, so companies won't have to cough up all the money at once. There's been a long debate about whether states have the right to charge these extra taxes on top of the usual fees mining companies pay, which is called royalties. The Supreme Court has now said that states can charge these taxes because it's important for them to make money from their own natural resources. This money helps them run their local governments and fund things like infrastructure and services. This ruling is a big deal for companies in the mining industries. For example, Tata Steel has set aside 17,300 crores to cover these potential tax demands, especially from the state of Odisha. This is a huge amount of money that could limit what Tata Steel can do with its cash, like investing in new projects or paying dividends. Steel Authority of India, or SAIL, might have to deal with these tax demands totaling around 3,000 crores. JSW Steel had liabilities of 4,700 crores, of which 900 crores have already been paid. These provisions represent a significant ongoing cost for these companies and could limit their financial flexibility over the next decade. However, companies that mine limestone, which is used in making cement, seem to be in a slightly better position. The taxes on limestone are lower than those on coal or iron ore, so cement companies like Ultratech won't feel as much pain. Even though their costs will go up by a bit, they'll likely be able to pass on these costs to customers. For most cement companies, the extra tax might only take a small bite out of their profits, around 5% of what they earned in financial year 24, according to an estimate by Nomura. Looking ahead, this new tax could make the cost of doing business in mining much more unpredictable. Different states might set different tax rates, which means the cost of minerals could vary widely depending on where they're mined. This unpredictability could also scare off new investments because companies might worry about suddenly facing higher taxes that could cut into their profits. The Supreme Court's ruling could also have an indirect effect on electricity bills. Since much of India's electricity is generated using coal, companies like Coal India are likely to face higher costs due to these taxes. There's a chance that these costs will be passed down the line. This could mean that the power plants might pay more for coal, and eventually these higher costs could end up being reflected in the price you pay for electricity. The exact impact on electricity bills will depend on how state regulators handle increased costs. In some states where electricity prices are tightly controlled, the impact might be less immediate. However, in states where power prices are less regulated, you could see prices go up more quickly. But more importantly, this raises the question of whether retrospective taxation is a good thing. At a time when India is trying to attract global investments, these regressive tax demands for past activities will scare investors away. Unless businesses are assured of a stable and predictive investment environment, why will they invest? Now let's finally talk about how China's troubles are getting worse. I know what you're thinking. Why are these guys speaking about China so much? Is this a Chinese podcast? Look, China is the world's second largest economy, and when something happens there, it'll affect the rest of the world. And ever since COVID, it always feels like something weird or crazy is happening in China. And in the last month or so, something crazy has been happening. But let me set the context in which the crazy stuff is happening in China. The Chinese economy has serious problems. First, for decades, it has relied on an investment-led growth model. It invested trillions to build massive amounts of physical infrastructure, including ghost cities, roads, and bridges to nowhere. This meant China grew at 8-9% for decades and became the second largest economy. Second, China also built its economic model around exporting and becoming the factory for the world. This was possible because of China's high savings rate. But on the flip side, it also meant consumption was always a small percentage of the GDP. Third, while this model helps a country grow initially, there's a hard limit to how long you can spend to grow. For one, once all the low-hanging fruit is plucked, every incremental dollar you spend generates less and less growth. Fourth, China also has a debt problem, but at the local government level. For decades, these local governments funded themselves through property sales, thanks to China's booming property sector. But that's now over. China started cracking down on its property sector in 2021, and since then, home and property prices have continuously fallen for over 3 years. Fifth, on a longer timescale, China also has a demographic problem because of an aging population. This leads to lower productivity and declining workforce. But now all the problems that had accumulated for decades have surfaced. The thing about the structural problems that China is facing is that when you are growing at 8% year on year, you won't notice them. But when growth slows down, as it has since COVID, these problems start becoming a headache. In 2021, the Chinese government introduced several regulations to reduce leverage and speculations in real estate sector. This had a dramatic impact on property prices. Property prices have been continuously falling since 2021 and there's no bottom yet. While this is bad on its own, what makes it worse is the fact that property is the biggest household asset. Most Chinese people don't invest in stocks and mutual funds, but in houses and land. This led to several knock-on effects. In response to falling property prices, many people chose to use their savings to pay off their mortgages rather than spend more. This was the same with credit card debt as well. And the people who were saving decided to put all their money in bank fixed deposits. So the result of this conservatism among consumers is a very low inflation rate. At a time when the entire world was battling inflation, China was experiencing the opposite. In fact, in 2023, China had a brief period of deflation. So with that background, let me explain why I am talking about all of this. As I mentioned earlier, property was the preferred investment for Chinese people, but the prices have been falling since 2019. Most Chinese households don't invest in equity. That meant the only other alternative were fixed deposits or government bonds. And both domestic investors and foreign investors have been piling into government bonds. Well, why? First, considering the terrible economic shape that China is in, bonds have become a go-to investment for domestic institutional investors and retail investors. Second, given that the Chinese economic problem won't be solved in a hurry, foreign investors have piled into Chinese bonds, expecting interest rate cuts. And third, falling inflation is a natural tailwind for lower bond yields, which is further attracting more investments into bonds. Remember, as yields fall, bond prices rise, and people can make capital gains. Now, the Chinese government and regulator are worried about this and saying that there's a bubble in Chinese bonds. And they are going to weird and extreme lengths to prop up bond yields. Regulators are resorting to everything from warning banks against purchasing government bonds, imposing fines, scaring banks with investigations, to even cancelling some bond purchases. But why? The first reason is that the Chinese government is saying it's worried about a Silicon Valley bank-style run where if interest rates were to rise, there would be massive unrealized losses on bonds held by banks. But this is a remote possibility considering China is facing deflation. They are worried that the yield curve might flatten. If both short and long-term bond yields are the same, the profitability of banks will be hurt because they can't make long-term loans at higher interest rates than short-term loans. This also doesn't make much sense. This is a weird situation for China to be in, but for observers like me, it's becoming entertaining. And that's it for today. We'll see you in the next one.